Welcome to Turning Hard Times to Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City. This is the 22nd day of January, 2019. And as always, I'd like to remind you I am the author of Jay Taylor's Gold, Energy, and Tech Stocks. And that's a weekly and a monthly newsletter. You can subscribe to it by going to miningstocks.com, or call us here in New York at 718-457-1426, 718-457-1426 during normal work hours. I would also encourage you to consider signing up for Chen Lin's letter. Go to chenpicks.com. Chen is especially astute in the biotech sector. He was on last week and talked to us about a couple of his favorites. And I also like to always remind you of Oliver MSA, Michael Oliver's wonderful newsletter. We'll be talking to Michael in just a second. OliverMSA.com. Keep your questions, comments, criticisms, and praises, whatever comments you have, send them on to questionsfortaylor@gmail.com. Questions, the number 4, Taylor@gmail.com. We do want to thank our sponsors for making this show possible. Our sponsors for this week are RN Resources, Novo Resources, Triumph Gold, Gold Mining Inc., Uranium Energy, and Klondike Gold Corp. I've titled today's show, How Could Anyone Possibly Like Donald Trump? Jayant Bhandari visits for the first time. Michael Oliver will be with me, as I mentioned, just in a second or two from now. And the surprise guest that I talked about last week will be Daniel McAdams, the executive director of the Ron Paul Institute for Peace and Prosperity. Americans have taken advantage of the fruits of free market capitalism, but out of the design of our government-sponsored educational system, our schools have kept Americans extremely ignorant of the virtues of the capitalist system, which explains in large part, I believe, why the political left in America is gaining so much power and is now threatening America with the overthrow of our government and the imposition of a dictatorship of the left. Jason Bhandari, who is a native of India and travels the world over looking for profitable investments, and is very much involved in the resource sector, recently wrote in a blog in which, one of his blogs in which he said, and I quote, "As time has passed, I have grown increasingly respectful of what Donald Trump is doing," end of quote. And he also said, and I quote, "I hope that America keeps Trump for another 6 years," end of quote. We will ask Jayant to explain why he has such a favorable view of Trump when perhaps President Trump is the most hated president since Richard Nixon, maybe more so. I mean, I remember the days of Richard Nixon, and I must say there wasn't nearly this much vitriol against Nixon. And I also want to ask him about some of his views on investing in a world in which asset distortions abound thanks to seemingly endless amounts of money created out of thin air by central banks around the world. When Daniel McAdams comes on the show after our first commercial break, I want to get his views on President Trump from his area of expertise, namely foreign policy, and Trump's desire to engage in peaceful trade rather than endless wars. What are Daniel's thoughts about Trump's desire to pull out of Syria, and why is the deep state so dead set against it? Is America's global empire threatened if we retreat from Syria, Afghanistan, Ukraine, and other places? Those are questions for Daniel, but right now I'm really happy to tell you that Michael Oliver is with me. He, too, has some very insightful views on geopolitics, I'm quite sure, but unless he cares to comment on those views, we will look for his usual guidance on key markets. Thanks for joining me again, Michael.
Hi, Jay. Very good to be back.
Very good to be back. Any quick note about Donald Trump? Thumbs up or thumbs down, or you?
It's thumb sideways. Some of his thoughts are somewhat along the conservative line of global intervention, but much of his domestic stuff is more leave it alone, which is good. Yeah. So he's sort of a mixed bag, but he's definitely enough of an upset to upset the orthodoxy.
Boy, is he ever.
Orthodoxy being what is called the deep state of both the Republican and Democrat Party. There's a similar phenomenon in France right now. In fact, the Mises Institute, Von Mises Institute in Auburn, Alabama, they have a daily letter they put out with various articles. There's an article today by a libertarian in France who went into the streets with the yellow vests.
Yes.
And who initially started as a tax revolt against huge gas taxes, fuel taxes.
Yeah.
And it's spread, and it's a multi-ideological movement now. In fact, it's so diverse, it's in fact basically anything that's anti the administration, anti the orthodoxy of Europe, from the right to the left, including libertarians. And it's a very interesting article. The movement has a lot of potency, and I think they're not going to stop. And I don't think Macron's going to survive it. And he, of course, is exemplary of orthodoxy, or the deep state of Europe, you could call it. And so things are changing over there, too, and it's popping up in different forms. Brexit was one form of it. The Yellow Jackets are another. There's instances throughout the world where this is going. Brazil just had an example of it where decades of state socialism were largely upended by a guy who didn't even have a political party. So this is popping up around the world in different forms that aren't really linked to each other. It's sort of a rebellion, I think, emotional, psychological, and economic rebellion against the orthodoxy of statism. So it's interesting and positive, I think. And I think it's indicative that this crisis we're about to have in the markets will have a political ramification.
I have no doubt about that.
The 2000 bear market, 2002, the 2008 bear market, there were no political upsets. You know, both sides worked together to reinflate the situation. This time we have a political fracturing around the world, which is very interesting. And I think it's indicative of the depth of this crisis that's about to hit.
Oh, I don't doubt it. Interesting times for sure. Well, be careful what you wish for, I suppose. Michael, let's get to some of the markets. Now, one of the really interesting things you put out was a 20-year chart showing the relative performance of gold compared to the S&P 500. Talk about that, if you would, to our listeners.
It's on your site, I believe, Jay. And
yes, we did post it there.
Listeners can go to it later or look at it now.
Yes.
The chart shows the spread relationship between the S&P 500 going back to 1999, you know, when the big bull was in blow-off mode in 99 and reached a peak in 2000. And where S&P was in percentage relationship to the price of gold, and it was 5 times the price of gold. Actually, it got up to about 5.4 times. So that chart shows it as 500%. So that was a peak in S&P performance versus gold. From that point onward, while you dropped all the way down to about 60%, so in other words, the S&P being 5 times the price of gold due to a combination of its downward bias or flat bias in the S&P between 2000 and 2007 and 8, it actually went up and down during that time. Gold was plodding upward, and so the spread collapsed all the way down from 500 level to a 60 level. It's a huge collapse in performance. So now at that point, though, this would be in the years of 2009 to 2011, that spread bottomed at under 100%, meaning under the level where there are par prices. And S&P has gained, okay? So it's gained from, let's say, 2011 through September last year when the S&P peaked. But the gain was only about 32% or so of the entire collapse that had occurred since 1990. So in other words, had you bought S&P in 2000 and held it to now and been short gold against it, your clock was cleaned. Okay? Gold vastly outperformed it, even despite the last 7 to 8 years rally in S&P performance. Now, if you surgically look at that spread chart, and there's a momentum chart that accompanies it, and go back to about 2002 in the fall, that's when the S&P made a low. Remember that bear market went from 1500s, went down to 700 area. If you then entered the spread then at an optimal place, in other words, a major bear low in the S&P, so you entered there, bought the S&P and sold gold, you never broke even. It continued down through 2011, and even with the multi-year rally we've had, that spread is still not back to the levels of the bear market low in the S&P in late summer, fall of 2002. So almost anywhere you want to intersect that chart, gold is in position to outperform. Also, our analysis of the momentum of the spread, which is on the chart on your site, the chart below the spread chart, it's set up a structure such that you can't back off much. The spread will change. It will indicate the S&P's recovery is over. It's now resuming. Gold is resuming an outperformance trend.
Yeah, it looks very close. It looks like we're almost kissing that area.
Like a couple bad weeks for the S&P or good weeks for gold, and it would totally break that recent 8-year uptrend.
Right, and I might just mention it's jtaylormedia.com, jtaylormedia.com, and you can see Michael's article that he wrote. It is posted on our site. Thanks for giving us permission to do that, Michael. Speaking of bad days for or bad time for the S&P or good time for gold, let's talk about the gold market today. It's up a bit, I think. It's reasonably strong, and we're seeing a lot of weakness on the S&P 500. As I look at it right now, we're looking at let's see, it's 2619. Are we getting any sort of crucial levels from your momentum work on the S&P?
On a near-term basis back to the downside. There's no question about it. The question is whether it will be enough to sustain a drive back toward, let's say, 2400, which is an area they better not ever see again. In fact, our last trigger numbers on annual momentum for the S&P rise about 20 points a month, but basically it's the kind of number that's coming up at you. So the S&P guys who think this is a great buy better keep it up here. They better not go back and get anywhere near testing the December lows. Even 4 or 5% above that is not acceptable, and I suspect they will. There are two alternatives to stocks, and we all know what they are. If money is uncertain in stocks, it goes to what? T-bonds. Okay, we got a huge bond rally during the S&P collapse in December, but the bonds have given back half of their gains when the S&P rallied from the December lows, which is logical. Okay?
Yeah.
Flight into safety, flight back out into stocks. Gold did not give up its gains.
That's interesting.
The drop that we just saw the last few days is all of 1.1% off the high close of the move. Mm-hmm. So rather than dropping up, let's say 10% back down, like the S&P soared up off its low, gold did not flinch. Mm-hmm. And we suspect the daily action of gold is about through on the downside, and it's ready to resume upside.
Mm-hmm. Well, I used some of your work, Michael, to give my talk in Vancouver the weekend, and the question that I raised is what will be the dominant safe havens for 2019? And I'm suggesting possibly a tattered and torn dollar may send some of those safe haven seekers over to gold and not just to the treasuries. Your thoughts on that?
Absolutely. Yeah. Yes, I agree. I think the treasuries are a flare type of counter trend to the S&P, meaning the major trend of T-bonds is down, meaning yields up. Okay, and this rally we just had in bonds is a flare type rally that was justified. We saw it coming. At 140, we got bullish, and T-bonds ran up to almost 149. Or now they're 145. So that made sense that the T-bonds would absorb some of that fleeing money. But the actual better behavior during that period is the other alternative, which is gold, as I explained. A lot of people are nervous about it, but it backed off all of 1% or so from its high close a couple of weeks ago. That's pretty pathetic in terms of how deep of a correction are we going to get, which a lot of people are looking for. We're not. No. I'm still looking for new highs for the last 5 years' highs come out sometime between now and mid-February.
Interesting.
One of the,
all right.
If we pop up through 1,300 again, I suspect it's on.
All right, Michael, just 30 seconds. If you could give us a quick comment on GDXJ, the junior miners. They're looking pretty good from what I can tell from the charts you sent out.
They're a positive trend, and so are the GDX, the bigger miner ETF. They're in positive trend. The recent pullback does not negate that on our long-term momentum charts. But I did caution in the weekend report that the better thing to look at if you own miners is not the miners themselves but gold. Until the public gets excited about gold in a big way, and that'll happen when you go through 1360 on gold. It'll light up the financial pages. At that point, money will pour into the miners, and we argue the miners they're a wild dog on a leash. When gold pulls back, they go down hard. When gold goes up, they go up hard. So it's like a wild dog on a leash. He goes front and back. And so measuring the technicals of the gold miners, we do it, but the better thing to look at at this point in time is gold itself, because it's the mama. It's holding the leash. And if gold doesn't flinch, but they do, ignore their flinch. Gold's in charge.
All right.
Gold goes up again, we think they're going to race.
All right, Michael. Thank you very much for that time, for your time and for sharing your thoughts with us. Always great to have you with us. Folks.
Thanks, Jay.